A key message in our secular forum is that we're in a world where investors are no longer having to reach for yield. We've now seen or in the middle of a generational reset in quality fixed income bond yields, and so investors should seize that yield advantage.
You led PIMCO's forum since you rejoined PIMCO in 2022 and published our Outlook Yield Advantage together with our group CIO, Dan Iverson. So what are some of the key themes, Rich? Can you walk us through?
Inflation in the U.S. and across the world and advanced economies fallen back close to target. Central banks have not only stopped hiking rates, they're starting to talk about cutting rates. The ECB has actually cut rates along with some other central banks. There was a growth slowdown in Europe, but in the U.S. we had, if anything, a pickup in growth in 23 and a decline in the unemployment rate to a 50-year low, no real financial instability. We've now seen or are in the middle of a generational reset in quality fixed income bond yields, and so investors should seize that yield advantage. We think that a lot of the macro monetary policy and inflation risk is now much better balanced. Some of that risk is migrated over to fiscal policy in the following sense. Governments, we think, going forward, if U.S. included, will have less fiscal space available to deal with future downturns. Interest payments on the U.S. debt now exceed the defense budget. We do think already we're starting to see implications of deficits and debt in global bond markets. We think that investors going forward will need to and will be compensated for taking on duration risk by earning a term premium. The U.S. dollar continues to be the global reserve currency. Treasuries are the global reserve collateral asset, which means that the U.S. enjoys what Charles de Gaulle once referred to as an exorbitant privilege.
Fed always say they're data dependent. Having been in the room when these decisions were made, what does data dependent really mean in practice? What does the Fed need to see?
Central banks are data dependent. It's also fair to say that depending upon circumstances and shocks to the economy, central banks can be more or less data dependent, that they are, and I think with good reason, because they're now close enough to their 2% inflation target that they can be looking more broadly at data on the labor market. And the Fed, by statute, has a so-called dual mandate, that it's charged to achieve price stability and maximum employment. And now that they're getting close on inflation, they are now shifting some of their attention and calculation to the state of the labor market, and thus their comments that if we see a material additional softening in the labor market, they would be prepared to cut even if the inflation data doesn't improve. I think if we get a good reading on the PCE inflation numbers, we'll get 2 more CPI reports, we'll get 2 more labor market reports, and if those are lining up and showing an economy that's running at or below trend with a constant or rising unemployment rate and falling inflation, I think they'll cut in September and likely cut in December.
We've now seen ECB and others cut rates already. Do you think others will follow? And from your prior experience at the Fed, how much do global central banks really coordinate, or where they don't?
A couple things. Global central bankers spend a lot of time meeting face-to-face and talking in person and comparing notes. They meet 5 times a year in Switzerland at the BIS. They meet twice a year in Washington at the IMF World Bank. They meet at the Central Policy Conference that the ECB organizes in June. They meet at the Jackson Hole Conference. There's a G20 meeting. There's a G7 meeting. In addition, central bankers set up phone calls, video conferences. The best known example is in October of 2008. after the global financial collapse of Lehman, there was an explicitly coordinated rate cut where all the major central banks cut rates on the same day at the same time. But that's really the exception. But what we do observe, Justin, in markets is we observe positive policy coordination. We observe rate hike cycles across countries, rate easing cycles. And what drives that is not so much coordination as the fact that we tend to have globally correlated business cycles with global inflation going up and down, and thus central bank reaction functions will deliver correlated policies. But they do spend a lot of time talking to each other, that's for sure.
Historically, inverted curve means a pretty good chance of recession as an indicator, and it looks like it is not the case this time. And why is that, in your opinion?
An inverted curve is simply a situation where the yield on a short maturity treasury, say a 3-month treasury, is above the yield on a 10-year treasury. That is abnormal. Inverted curves tend not to persist, and inverted curves tend to re-steepen when economies go into recession and central banks cut rates. It's not an infallible signal. We've had a couple of occasions in the U.S. where curves inverted, and that was not followed by a recession. Now, I would argue that sometimes the correlation could be spurious. For example, the U.S. yield curve inverted in 2019, and I, of course, was following that then because I was Fed vice chair. And we did have a recession in 2020, but in January of 2020, there was no recession in sight. Unemployment was at a 50-year low. Inflation was just a touch below target. The Fed had cut rates in order to provide an insurance cushion against the economy. Yeah, there were some mumblings about a trade war, but looked to have been fully absorbed. And so I would argue that the correlation between the inverted curve in 2019 and the recession in 2020 was entirely spurious because of the pandemic collapse. I think had there not been a pandemic, there would not have been a recession.
Can you walk us through some of your thinking in terms of outlook for public fixed income?
Investors can put together a high-quality portfolio of sovereign bonds, investment-grade corporates, mortgage-backed securities, perhaps some private credit or hedge fund allocation. These are equity-like returns at a fraction of the vol with the potential for capital appreciation if in a future downturn, and there will be a future downturn at some point, the Fed cuts rates aggressively, bond yields can fall and deliver a capital gain.